predicting the energy market sometimes feels like, I don't know, playing chess with the fate of the global economy, but blindfolded. Thankfully, we've got Arne Lohmann Rasmussen's report, Energy Market Drivers, to guide us. And the subtitle, well, that just adds a whole other layer of intrigue, right? Geopolitics in focus, but keep an eye on a potential downbeat oil market.
Yeah, Rasmussen really hits a nail on the head with this one. He highlights this kind of push and pull happening in the market. On one side, you've got the whole Israel-Iran situation, which, let's be honest, has the potential to blow up oil prices faster than you can say geopolitical crisis. But then on the other side, there are these whispers, right? Analysts are saying global demand might weaken, which in a normal world should help keep those prices from going haywire.
So it's a classic tug of war, but instead of two teams of kids, we've got global superpowers and the fate of, well, everyone's energy bills hanging in the balance.
Exactly. And the thing is, we're not even sure what Israel's next move will be. Their security cabinet is being incredibly tight-lipped about the whole thing.
Which just throws a giant question mark into any predictions.
Yeah.
Right? I mean, how can analysts, even the best in the business, make accurate forecasts when one of the key players is basically operating in the shadows?
That's the thing about uncertainty. It throws the entire market into a tailspin. And it's not just Israel's next move. We've got the potential involvement of U.S. military bases to consider. Not to mention the neighboring countries, right? They're caught in the middle, worried they might become collateral damage if Iran decides to retaliate.
So we have geopolitical uncertainty, a dash of potential military escalation, and a whole lot of nervous neighbors. Not exactly the recipe for a stable market, is it?
Not quite. But Rasmussen does point to one potential bright spot: China.
China. You mean the same China that tried to stimulate their economy earlier this year? It didn't really go anywhere.
Yeah, well, they're at it again. They're about to announce some new fiscal measures, and there's hope, maybe a little cautious, but still hope that these might actually make a difference.
Because a healthy Chinese economy usually means a healthy appetite for oil, which could send those prices climbing, right?
Exactly. But here's where things get even more interesting. Remember all that uncertainty we were talking about? Well, it's got investors a little jittery, to say the least.
And by jittery, you mean?
I mean, we're seeing a huge surge in speculative short selling in the oil market. Basically, investors are betting against oil, hoping to make a profit if the price goes down.
So they're essentially borrowing oil, selling it high, and hoping to buy it back low later on.
You got it. But the million, or should I say billion-dollar question is, what happens if they're wrong? What happens if some unexpectedly good news hits the market?
Like those Chinese stimulus measures turning out to be a home run.
Precisely. If that happens, these short sellers could be scrambling to buy back oil at a much higher price just to cover their losses, and then we're talking about a potential price explosion.
It's like a high-stakes game of chicken, but instead of cars, we're talking about the entire global oil market.
Yeah, with billions and billions of dollars on the line. But speaking of predictions, Rasmussen and his team at Global Risk Management, they actually took a stab at forecasting where these oil prices might go. Now, keep in mind...
No one has a crystal ball, right?
Exactly. It's just one perspective, but they are, they're the experts.
So what's their take? What are they thinking?
Well, their baseline prediction is that Brent crude oil, that's kind of the benchmark, it'll hover around, let's say, 77, 80 terms per barrel for the rest of this year, and then climb up to about $80 in 2025.
Okay, so relatively stable, at least in their view. What's the reasoning there? What are they basing that on?
A couple of things, really. They're banking on, the global economy. They think it'll improve, maybe get a little boost from those lower interest rates we've been seeing. Plus, they're expecting China's economy to pick up steam, like we were talking about earlier.
Right, right.
And then there's OPEC, plus they might be adding more oil to the mix, although, and this is important, they might not increase output as much as they initially planned.
Because, let's be real, OPEC Plus is more like a fragile alliance with a history of not always playing by the rules.
Exactly. I mean, last year, for example.
Actually, you know what? Let's save the whole OPEC Plus saga for another deep dive, because that could be a whole episode in itself. For now, let's stick with GRM. Did they have any other scenarios, just in case things don't go quite as smoothly as their baseline prediction?
They did. They laid out what they call an escalation scenario. Basically, they're saying if those geopolitical tensions, especially between Iran and Israel, if those get worse, well, then we could see Brent prices jump to the mid-$80 before the year's end.
And what about the worst case scenario? The what if everything goes wrong scenario? What does that look like?
It's the nightmare scenario, right? The one where Iran decides to block the Strait of Hormuz. That's a key shipping route for oil, and if that happens, well, GRM says we could see oil prices skyrocketing above $100 a barrel.
Yeah, that would definitely be a shock to the system, not to mention everyone's wallets. But it's not just GRM making these predictions, right? What are other big players like OPEC and the International Energy Agency, what are they saying about all of this?
Well, that's where things get even more interesting because you've got OPEC, always the optimist, right?
Huh.
They're predicting oil demand growth will hit 2 million barrels per day next year. The IEA, on the other hand, they're forecasting less than half of that.
Wow, that's a pretty big difference of opinion.
Yeah.
Why such a discrepancy? What's driving those two very different outlooks?
It seems like OPEC's putting a lot of faith in the global economy, especially those emerging markets. They're probably also assuming that China's economy will rebound, if those stimulus measures actually pan out. The IEA, though, they're a bit more cautious, maybe factoring in things like interest rates staying high in some developed countries, or the fact that, the world is slowly but surely shifting towards renewable energy.
Which is a whole other can of worms we haven't even begun to open.
Exactly. And this difference in opinion, it's not just academic, right? It has real-world implications. If OPEC's right and they pump a ton of oil into the market, but the demand isn't there, well, then we could see prices plummet. But if the IEA's got it right and demand outstrips supply, get ready for even higher prices than anyone's anticipating.
So it really is a guessing game, a high-stakes guessing game with the global economy hanging in the balance. And speaking of stakes, let's bring it back down to earth for a second and talk about what this all means for our listeners and their own, personal investments.
Remember, knowledge is power, especially when it comes to your money. We're not here to give financial advice, but we are giving you the information you need to make those decisions yourself.
So with everything we've talked about, the oil prices, the geopolitics, the economic forecasts, what are some key takeaways our listeners should keep in mind?
First things first, know your own risk tolerance. Are you someone who can handle big swings in the market, or do you prefer something a little more, stable and predictable? Then think about your investment goals, right? How would different energy price scenarios impact your portfolio? If you're heavily invested in energy companies, well, then a spike in oil prices might be good news for you. But if you're invested in industries that are sensitive to fuel costs, like airlines, for example, then those higher prices might not be so welcome.
Exactly. It's all about understanding what you own and how it might react to different market conditions. And hey, if you're ever unsure, talk to a financial advisor is never a bad idea. Before we wrap up our deep dive into Rasmussen's report, there's one thing that's been bugging me. He spends a lot of time talking about those traditional economic factors and the geopolitical risks, which are all important, of course.
Yeah.
But he kind of glosses over the whole renewable energy thing. Like it's just a footnote.
Yeah, I see what you mean.
It just feels like a pretty big factor to overlook, don't you think?
It is. And you're right. Rasmussen, he acknowledges the energy transition, sure, but he doesn't really dig into how it might impact oil demand and prices.
It's like the elephant in the room that everyone's trying to ignore. Or maybe like a giant solar panel casting a shadow over the entire oil market.
Now that's a visual.
Yeah.
But you're right. We're on the verge of a potential energy revolution here. And this shift to cleaner sources, it could happen a lot faster than people think. What if oil demand starts drying up, not because of some temporary economic blip, but because the world is fundamentally moving away from fossil fuels?
I mean, that's got to have a huge impact on those long-term oil price forecasts, right?
Yeah.
Even the ones that factor in, like all the geopolitical stuff we were talking about.
Oh, absolutely. Rasmussen's analysis, it's good, don't get me wrong, but it might be missing a pretty big piece of the puzzle. This shift towards renewables, it's not just some sideshow. It has the potential to completely upend the energy market, and maybe sooner than a lot of people realize.
It's like that saying, the future is already here. It's just, not evenly distributed. What we're seeing with renewables, it might seem niche now, but it could totally disrupt the whole energy landscape before we know it.
Exactly. And that's what makes this whole thing so fascinating, right? Exciting, but uncertain. We're at this crossroads. You've got these traditional geopolitical forces pulling in one direction, and then you've got this tidal wave of technological innovation pulling in the other.
A real energy tug of war.
Yeah.
So where does that leave investors? What are they supposed to do with all this information flying around?
It's not about trying to predict the future, It's about understanding the forces at play. Don't get caught up in the headlines and the short-term ups and downs of the market. Think bigger. What if electric vehicles really take off? What if solar and wind power become so cheap and efficient that, everyone's using them? How will those developments impact oil demand? And what does that mean for my investments?
So instead of trying to outsmart the market, our listeners should be thinking about, like, diversifying their portfolios, right? Looking at the long-term potential of these new technologies.
Now you're talking. The energy landscape is changing, and your investment strategy needs to change with it.
Adapt or get left behind, as they say. And on that note, we'll leave you with this. As we navigate this increasingly complex energy landscape, what other disruptive forces might be lurking out there, just over the horizon, ready to reshape not only the oil market, but the entire global economy? Until next time, happy investing. And remember, knowledge is power.